What's going on, everybody? Michael Silva here. Jerome Powell recently stated that we must keep at it until something breaks, the job is done. That was in his most recent statement, August 26, 2022. We're going to be diving into that in many charts in today's stock market brief, a shizo. Now, I want to remind everybody that the Fed is in a tightening cycle, and they're tightening into a slowdown. And when the Fed balance sheet goes down, right, liquidity out, volatility goes up. And you could see that in the S&P 500 as we're seeing lots and lots of volatility. If you're new here to the channel, you probably don't know what the expected moves are, but we'll be going over those for the monthly, the weekly, and even the quarterly because, well, it's a month-end, quarter-end, weekend, right? Welcome to October. Ooh. Now, I want to go back to this one quote from Danielle DiMartino Booth at a Hedgeye event, and she had stated that, well, I'm just going to read the quote. I think Powell has grown himself a pair. I think he is going full Volcker. And what's interesting about that, in the August 26th statement, he mentioned Paul Volcker multiple times, 2 times. And if you pay close attention here too as well, which, some people may have picked up on this, but his statement says, we must keep at it until the job is done. And keep at it, right? That's actually the title of Paul Volcker's book, Keeping at It. So pretty interesting stuff here. And it really does seem like, he has grown himself a pair and he's going to continue tightening into this slowdown to really fight inflation. And if that is the case, as liquidity obviously continues to exit, right, volatility in the S&P 500 can continue, and potentially something could very well break. It's a time to be very cautious. Let's look at the calendar for the week ahead. And you can see the things highlighted in red here. I'm actually just draw some arrows to them. So the red boxes, those are considered major events going into next week. So we have unemployment, we have non-farm payrolls, ISM numbers, we have balance of trade, ADP employment, JOLTS, and we have ISM as well. But notice here throughout this entire, pretty much every single day throughout the week, we have Fed Bostic, we have Fed Barkin, Fed George, Fed Bostic again, Fed Williams, Fed Logan, Fed Mester, Jefferson, Daly. We're talking, we have just a barrage of Fed speakers, Evans, Cook. It's literally just nonstop down the list. So, next week, we not only have a lot of economic data dropping, but we have a lot of Fed talk coming out too as well that can really shake markets back and forth. Now, I want to get into this because as liquidity is exiting the system, volatility is increasing. And some of these companies, the top companies in the S&P 500, which is a cap-weighted a structure, cap-weighted index, we have things like Apple and Tesla that, Apple just recently got hit, Tesla got hit a little bit too, but they're still, doing incredibly well in the midst of all of this current volatility. And I want to remind everybody that coming into 2022, if you take a look at, the NASDAQ composite, right, the S&P 500, the Qs, IWM, etc. What you'll notice is the market was really, and not really actually the Qs, and I'll explain why, but the market was really just driving itself up. But if you look behind the curtain, there were stocks that were just plummeting to the downside. And it was very few stocks that were holding these large indices up. And the large indices was the S&P 500, the NASDAQ 100, and etc. And it's because these stocks have not got hit. But now we're starting to see some weaknesses brew. So if we take a look at these stocks, just take a look here at the COVID low and where we are currently right here. We're in the midst of a lot of volatility. This could be very well considered a stage 2 markup, and we could be in stage 3, which is distribution, and distribution eventually leads to decline. So you got to ask yourself, if Apple gets hit, down to the pre-COVID high, which isn't all too insane in my opinion. It's hard to believe that can happen, but if that drops from 130 to 80, what kind of effect is that going to have on the S&P 500 or the NASDAQ 100? It could bring a lot of damage. Take a look at Microsoft. Microsoft hit another 52-week low. Now, it's stated that weak stocks, they get weaker, and this is a 52-week low. It's been just look how brutally it got beaten up, right? I can't wait to be more bullish, but right now we're under the 40-week moving average, under the 10-week moving average, which are the 50-day, 200-day moving averages, and we're continuing to get beaten down. These are starting to actually curl over completely, right, and decline, which means that we can very well get bounces, but we're still pretty far off from where even the COVID high was right here, and that was pretty high. So to think that we can't come down back into this range, I mean, why not? Why couldn't we if they're tightening, right? And if they do, and this does continue to head down this, you gotta think very tactically and strategically as to what these indices may look like if you just continue to hold while the market gets pummeled. Take a look at Amazon. Amazon is also pretty far off. I mean, this one's gotten hit a little bit. You can see a very clear stage 1, stage 3, right? This right here was stage 2, and then now we're in a decline phase. So, you know, there's no reason to believe that this is a bottom by any means. So if this continues to come down further, what like is it going to come retest the COVID low, which is right here? We already bounced, you know, somewhere around the 100 marker, which was, you know, past the COVID high over here, the pre-COVID high. So if it does continue to break down and the trend continues downwards, what's that going to look like in the S&P 500, right? If you take a look at Tesla, right, Tesla has hardly gotten hit. I mean, yeah, it's down around 30% year to date. It's a more, you know, it's a higher beta. It's very volatile. But when you really put it into perspective here, I mean, just take a look, right? Where are we? Where was the COVID low? COVID low was right here. COVID high was right here. So imagine if we were to just come to retest the COVID high, as many stocks, including things that are big names like Meta. How about Netflix, right? Those things broke their COVID lows. So to think that Tesla can't come down and retest just a COVID high, which is at 60, yeah, it sounds crazy. But I mean, when you look at the market structure, this simply looks like a stage 1, a stage 2 right here, which is the markup phase. And this could very well be a stage 3, potential stage 3, where we're going through distribution. So you're seeing large euphoria, large swings back and forth, and potentially, you know, we can just be breaking down here in the near future if something does break. And what happens if Tesla really breaks down to say $60? What kind of effect is that going to have on the marketplace? All right, I'm not saying this to predict. I'm trying to put things into perspective. This is the reality. Take a look at the moving averages, right? If you like moving averages, just take a look, right? They went flat, right? And then, you know, this was during the accumulation phase, and then we just burst through to the ceiling. We back tested right over here, and then we started ripping up higher when the Fed stepped in, right? The Fed basically stepped in with unlimited QE here, and we shot right up. Well, now you can see the moving averages, the important ones, right? 40-week, 10-week. If you look at stage analysis, look at like Stan Weinstein's book, right? I forget the name of it off the top of my head, but he uses a 30-week moving average. I know he may be using a 40-week now, from what I understand. But just take a look here at the moving averages, right? The 40-week is starting to curl itself over, and we're trading under it. The 50-week, right? It's kind of just chopping back and forth in a neutral phase, but we're trading under it. This is where breakdowns can occur. Paul Tudor Jones said it best: nothing good ever happens under the 200-day moving average. Well, the 200-day moving average is also known as the 40-week moving average, okay? If we continue on, look at Google. Google broke down from this, you know, bearish rectangle, bearish flag potential, and this right here, a full measured move, would take us to around 75, which to me is very hard to believe. Even a measured move of this channel right here would take us, you know, right back into this period of consolidation where we broke out, and that's right around 90, you know, 90 to 85, and we're not even too far off of there. We're about $5 away. Okay, so yes, if these big mega caps continue the trend, which, right, the trend is your friend until the end. So I get why everybody would want to try to buy bounces, and you can tactically and strategically do that, but you need to understand that if we bounce, boom, where do we go to? Do you really think that this is the bottom? The Fed hasn't even stopped yet. This is the bottom, and we're just going to go like this. It's going to be a drawn out process, at least in my opinion. It's going to be not some sort of V-shaped bottom, unless the Fed does something just crazy, you know, insane again. But it seems like, you know, it's Jerome Powell's last term. He's telling us he's going to keep at it. He's quoting Volcker and the title of his book in the way that he's talking. And it's getting to the point where it seems like, you know, everyone's blaming him for inflation, and that's what things are doing. And now he's like, this is my last term. I'm gonna solve for inflation, and I'm gonna leave like Volcker did, right? Like Volcker did. So it's all speculation at this point. We need to trade price, and the trend right now is clearly telling us to just back off, and be very cautious. The 10-year yield is continuing to perpetuate itself. Boom, boom. Just it continues its trend, right? So is this going to eventually take a little bit of a breather? Yeah, absolutely. At some point, this is going to have to take a breather. But as it stands right now, it's continuing to press higher and higher. If we take a look at TLT, the bond market continues to just follow its trend, right? Down, 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 right? Eventually, this will take a turn, and we got to be very cautious when it does, because the thing is here, right, as 10-year yield goes up, right, and this is why I'm pointing this out here in this section, is because when the 10-year yield rises, debt becomes more expensive, right? And debt becomes more expensive. What does that do for individual stocks? Well, I mean, heavy growth stocks get hit. The 10-year yield is rising, and look at Apple, right? Now it's starting to go through a lot of volatility. Microsoft, it's starting to fall, right? Amazon, a lot of volatility. These are high growth stocks, and they have a lot of debt. And as the debt becomes more expensive to service, well, what do you think happens? They get hit, right? So we got to continue to watch that. And then if we take a look at the TLT for bonds, we always got to be on the lookout for, the safety potentially trade to come back into bonds. That would be more of a stage 1 of the economic cycle, which we've talked in prior episodes. Right now, in my opinion, we're in stage 6, and that's where bonds go down, stocks go down, and commodities go down. The difference between stage 6 and stage 1 is that bonds go up in stage 1, but stocks and commodities continue to go down, okay? And we'll talk about that in later episodes, but keep in mind, it's not just these names that are getting hit somewhat and have a lot room to fall if the market continues to get hit. But just take a look at some of these names, right? Verizon is getting absolutely crushed, hitting 52-week lows. I mean, we're at 55 just earlier this year, and now we're trading down to 38. Look at Carnival Cruise Lines getting massacred on the last trading day, right? Contraction leads to expansion. We move to the downside. This is one of the trade setups that I actually put in the Patreon group, and we said, is the trend going to continue, or are we going to break out through 11? Well, it went, I think I posted it right around this area over here, and then it continued its little, expansion, contraction, and bam, the trend continued to the downside. This is exactly what can happen in all those big mega cap stocks, so we need to be prepared for that. Take a look at Nike getting hit down the last prior trading day. It was down 12.81% on the day. I want to just reiterate this because this is bearish stuff that's going on in the market, so we need to be careful. But this is where the biggest opportunities will come when this storm passes. When volatility subsides and when we don't have trending volatility, which we will get into volatility here momentarily, when that subsides and we can start being in this investable area again, these are going to be amazing opportunities. But it's going to come at a point where no one's going to want to step in, or no one's going to have the opportunity fund on the side to be able to do so. If you take a look at Procter & Gamble, 52-week low, these are some large mega cap stocks that are getting crushed. Remember, even in safe stocks, if volatility VIX is trading above 30 or even the high 20s, anything and everything could get hit. All right. So the only thing safe is really just to be in cash at that particular time. Look at Intel. Intel's getting completely crushed. Intel, do you really think Intel's going to go anywhere, right? Of course, it's a bad area given the economic environment, and this will offer up great opportunities. But look at the trend. The trend says down. So if you buy here, right, Brian Shannon often says, if it doesn't scare you out, it'll wear you out. So if you buy here, cool, you might catch a potential bottom. It goes up to 30. You're like, yeah, I'm doing good. Boom, it might go down further, right? We don't know because there's no signs yet of a bottom or accumulation or anything, but it can go sideways for years. It can go sideways for 4, 5, 6, 7, 8, 10. Who knows? No one actually knows what will happen. We need to be very strategic in this environment. I know that there's a lot of confidence and a lot of talking heads saying that these are the best opportunities right here, but it is what it is, right? Based off of what? Based off of what are these opportunities coming from? And this is all opinion based, right? Maybe this will be the bottom right here. But why would it just be a V-shaped recovery right out of the gate? It just doesn't make sense to me. And look at Taiwan Semiconductors, right? Another 52-week low here, continuing to get crushed. I mean, it was earlier this year, we had a high of 140. We're trading below 70 right now, okay? Below 70. And remember, things can get hit, right? If it loses 50%, and people forget this often, right? Let's draw this out actually here. So 100%, right? Boom, boom. Okay, that'd be right here, okay? Well, say if we lose 50%, right? So if you go down, 50%, boom, 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 right? You can minus 50%. Well, you can lose another 50%. And, even at that level, you can lose another 50%. Right? And then you can lose another 50% from that level, and then another 50%. It doesn't end, right? Let's get into volatility. The VIX. VIX has a very similar weekly candle than it did prior to the recent kind of a last rally that we went through, right? Which I know there was some controversy around, the VIX being manipulated here, but I found it interesting because we do have a, kind of a spinning top, high wave type reversal candle, doji candle, and we have a very similar one right there. So hey, yeah, maybe we do pull off and then we can get a little bit of a relief rally. But we are trading above 30, okay? When we're trading above 30 in the VIX, you got to be careful because this right here is the area, and if I had a longer chart, you could see it, but this is the area, right in this area, this 30, 35, that if we start getting outside of it, we can see quick, explosive moves to the upside, okay? Now, trading above 31, that means everything and anything could potentially get hit, so we need to be very cautious of that. RVX, which is Russell Volatility, is at 36.77, okay? Be cautious of that, and you can see here, we can have this little trend over here. I mean, this thing could be just compressing. We can just see a blow-off move, right? So do not rate that out. Yes, it also has a very similar type candle that it did right here. Indecision, maybe it pulls back a little bit. Okay, cool, but you just need to be cautious, right? So we'll continue to say that. Look at NASDAQ 100 volatility. It's 36.61. I'm sorry, people. This is where crashes can happen. This is where crashes could take place, so we must be careful. Yes, we can also get, a face ripper of a rally, and that'll be great, and we got to be tactically and play that. But as it stands right now, we just got to be careful. Let's hop into the S&P 500. Now, down here, I have the expected moves for the quarter, right? This is something that I share with my Patreon. Fourth quarter, we're looking at a plus or minus 461, and these are the numbers right there, so go ahead and screenshot them. And then the month of October, right here, the low and the high, those are the expected moves, okay? If you look on the screen right here, the dashed lines, those are the quarterly expected moves, and the monthly expected moves are the solid black line. So basically it's saying that, hey, the options market, based off of implied volatility, is pricing in the market risk potential, right, for this month of October, plus or minus 259 points. So that can bring us down to around 3,300. Now, guess what? The market has been highly inefficient at forward-looking risk, at handicapping the risk going forward. The weekly, we've been breaking it every week, except this last week. We didn't even touch it, but we did break through the monthly. Okay, but we stayed within the quarterly, though, too, as well. So it's been highly erratic for handicapping risk, but it'll give us a good idea, potentially. We're disconnected from the quarterly 5 EMA. That is above us, right? So on the higher end, look at where the monthly expected move goes. It goes to just about 38 and some change, right? So here we go, monthly expected move, 38.45. Now, what you'll notice is if we get up there this month, we're still in bear market territory. How do I know that? The red shaded area is 20%, minus 20% from the peak over here to this portion right here. That's minus 20%, okay? I'll draw that in. Boom. Okay, now what I find very interesting too, and I know people seen these because I've been talking about it since basically March, this right here is current. I'm going to show you what 2008 looks like right here. So this is current, this is 2008. Current, 2008. Look at these quarterly candles. Look at the quarterly 5 EMA. That's gnarly. It's almost the same thing. It's tracking darn near perfectly. Now, I also want to reiterate that we typically, when we get one quarterly close beneath the 5 EMA, at least everything since in the last 20 years, the Fed has stepped in and done something. Now, when we've gotten in the last 22 years, where we've gotten two quarterly closes beneath the 5 EMA, there's been 2 times when that happened. Want to know? You probably already know because I talk about it. It was during the dot-com bust, right before the big bust came, and then the great financial crisis. And then the Fed stepped in much later. So this is the first time we've had 2 quarterly closes since just about the great financial crisis. And prior to that, once again, the dot-com bust. Okay? And it's tracking itself very, good here. And you want to see what happens shortly thereafter. That was the great financial crisis. The great financial crisis, I know people say, well, it's not the same thing, right? Something has to break. The Lehman Brothers, it broke. Well, now there's all this news about Credit Suisse and other big banks. So there can be an event that potentially happens, and price is giving us that advance notice, right? People are getting scared. Volatility is increasing, quantitative tightening. So if this happens, Do you really want to just hold and say, yeah, I'm going to just call the bottom, I'm going to call the bottom, I'm going to call the bottom, and then get completely wiped out? And when the best opportunities arrive, and let me remind you, in 2009, during the bottom of the great financial crisis, that's when, a lot of innovation comes from. So this big reset that happens, a lot of great things come out of it, right? We've had, think about like Facebook when it was coming out of that, and just how how much the social platform and how we connected with individuals changed coming out of the great financial crisis. What about Bitcoin, right? Bitcoin came out around that time too. The white paper, right? Wasn't that 2008, 2009, somewhere around there? Airbnb, right? All kinds of different companies came and all kinds of innovation came outside of that. So I can only imagine that when we get through this, right, whatever this is that we're going through, whatever you want to pretend it is, whatever the case is, when we get through it, this is going to be an incredible opportunity. But in order to take advantage of these opportunities, you got to survive this storm. That's as simply put. Let's take a look at this by Michael J. Kramer. He posted this. I love this, right? He's tracking it. I don't know if this is daily or weekly, but he's tracking. You can follow him on Twitter. The yellow is 2008 and the white is 2022. And just look how well it is tracking the movement on this analog. And I know a lot of people say it's different, it's this, it's that. It is what it is, right? It's still very interesting to me, so say what you want. Now, we do have seasonality, right, coming up. And a lot of people might look at this midterm seasonality chart and say this, okay, we're coming into October, and after October, we're here. Boom! We're going to see a huge, massive rally. Cool, maybe, and we got to be open to that, right? Because if we're just all bared up and then the market goes against us and we're trying to short while we're getting our faces ripped off, that doesn't sound too pleasant, right? You want to make money in up market, you want to make money in the down market. That's just how it is. Or protect your money in the down market and then make money in the up market, right? Whatever you choose. But if we take a look at this seasonality chart, right, we're looking at the red line, which is second-year Democratic president. This red line is tracking very well, which we discussed on the prior video. It has this kind of head and shoulders formation right here, right? And, it hit a low here coming into the end of October. And we did, right? We closed at a low. It's pretty bearish looking. The monthly, the quarterly, the everything, all those candles really look ugly. And then look at how October, we get this little bump up rally in October, but then it gets faded pretty hard for another new low into November. So here's the thing. Yes, seasonality is on our side, right? To see a bump in October, but also it's tracking very well based off of the great financial crisis. So what does this mean? What do you do with this? Can you really make a trade plan with this information? In my opinion, you can't, because it can go both ways. Okay, it's as simple as that. So the trend right now remains down. Can you tactically play bounces? That's what you tactically need to do. In times of high volatility, it's better to be a trader, and it allows you to use less capital to get decent sized gains with less capital because volatility is high. I've said this many times before. Imagine you're trading, just for an example, $100,000 portfolio, and you're used to investing at the long side under 20, right? Say 20 to 15 right here. But all of a sudden it goes from 15 to 30 to 40. All right. So that 100K, it's the same balance, but because volatility is that much higher, because it's almost double, right? Because it is double. You're not trading just the 100K now. Now you're trading basically, 100K, but it's moving back and forth as if it's 200,000. Okay? That is what volatility does. So you need to be volatility adjusted in this portfolio. And I'm doing a lot of rambling on this video, but I want to really get this kind of information out because, it is a difficult time. Let's take a look at the monthly time frame. The monthly chart, right? The same lines on the screen, right? Quarterly expected moves, monthly expected moves. Look at the monthly close. Yikes. That looks disgusting. We closed at a low. Typically, if that happens, we'll get some sort of follow through at some point. It'll go lower than this point, right? And this happened on a Friday. So yeah, can we get a bounce tactically? Well, we're going to have to look at the 15-minute time frame in order to do so. We're disconnected from the monthly 5 EMA. Remember, when we're disconnected from the monthly 5 EMA, it's one of the most frequently tagged EMAs. You can see it tagged it actually. It tagged it right here, here, and then see how it disconnected from it on this big, nasty red candle. We even came back to tag it. Guess what? We closed down here. We came back to tag it. We tagged it. We tagged it. Now we're closing way down here. The 5 EMA is going to probably come down a slight more. So yeah, are we going to tag it? Are we going to get a rip back up to 3,800 in the beginning of October? Maybe. Right? Maybe it comes down a little bit further, then pops up, and then everyone's like, see, the rally's coming, the melt up is coming. but understand the trend. Understand that the trend is still down. We have lower highs and lower lows. So you got to not get fooled by bounces in this market. It's going to take time to get a bottom. You do not need to tag the exact bottom. You don't need to make a lot of money going into the next bull market, okay? Just like you didn't need to tag the exact top in order to protect yourself from all that downside, okay? If we take a look at the price percent oscillator down here, wind is at our face on a monthly time frame. Boom, pointing straight down. Boom, pointing straight down. Histogram, boom, pointing straight down. So, wait for at least some sort of signal that this is, strengthening, but it's not right now. And volatility is high. So what does that mean? Be careful. Weekly time frame, we're right there at the 200 weekly moving average. Did we close below it? We closed at 3585. Weekly 200 is 3589. So yeah, we closed below the weekly 200 period moving average. I want to bring up the expected move for the week. I'm just going to list it, right? This is the it's drawn out on the screen for the week, and I want to actually, before I do that, I want to call out something here on the volume shelf profile. We have a lot of volume right here in this area. All right. So to see this break down, I think that is very possible. And we would come back to where? I think that is very possible to come back into, I'd say right here, 3,200, right? That's where we had prior resistance here, right? We broke down from that level. We've acted as support in this level. Even if you go back through history, there's some more, movement around this area. But then also before that, you can see even further down in this area, you see this big volume shelf profile. I'll draw it out once again. This volume shelf profile here can potentially act as a magnet where we come back down, fills a lot of those open gaps from the daily time frame. And what? Like, is that too hard to believe? I mean, kind of hard to believe that would happen. But if those big mega cap stocks continue to get hit and they go towards their COVID lows or even to their previous COVID high, this is going to get taken down. There's no doubt about it. Now, where does this stand right now as far as the volume shelf profile goes? Take a look here. Take a look at just how we have this big kind of air pocket right here. All right. So we've broken down, right? We bounced from this area. Now we're just in the middle of this air pocket right here. And this right here, that's not a safe place to be. All right. So this big open air pocket, it's going to get probably moved to where some prior liquidity was in the very near future. Now, the trend still remains up on the 200 weekly moving average, but closing below it's not the greatest sign. So let's see if we can recover that. Where's the weekly expected move for the S&P 500? We're looking at a high of 38.17. We're just going to say 38.18 for the week. And then below us is 35.69. So, okay. Once again, 38.8. I'm just going to go like this. I'm going to just screenshot it. I'm going to put it right here for you guys. Okay. These are the expected moves for the week there on the S&P 500, okay? The SPX. Now, if you're in the Patreon group, you already know this because I share like 30, 40 products, including all the stuff that we talked about, okay? Let's go on and look at the 15-minute time frame. This nasty looking close right here, typically into a Friday. We can get some continued follow through, so be very careful there. Bitcoin looks like it's about to break down. I'm going to make a separate video on that. 5-day moving average is continuing to just decline. All right, so guess where we tested, right? We came here, above a declining 5-day moving average, we came here. Above a declining 5-day moving average, we came here. Above a declining 5-day moving average. And this is why you got to be careful, right? It followed the trend to the downside. So until that we can get above and have a close above this declining 5-day moving average, right? Starting to flatten out right here. Until we can get above it and it starts turning back up, right? Whatever that might look like, boom, or whatever the case is, then we could become a little bit more bullish on the current environment. Now, if we start getting price ripped higher, take a look here on the shorter time frame. This volume shelf profile brings us to around 382.50 to 385. So that could be a potential area of resistance. As you can see right here, we've had some prior price action in that area. And now what it looks like is we're just trading within it looks like a lot of open interest, building up in this area, which could create some sort of squeeze when we really start to break down from it, okay? And we've seen that same type of stuff happen here and in the past that we've talked about as well. Let's go over a couple stock market indicators. I know this episode's getting a little bit long. Pring bottom fisher now, our signal line and our Pring bottom fisher itself is below the -30. So when I want to feel a little bit more confident going long, I want to see this start to turn around. So if I zoom into this, you can see here that when the signal line started to cross through it, it started to mark a potential bottom right in this previous stock market collapse. That was a pandemic crash. And then over here into 2018 to 2019, which was termed the Christmas Eve massacre, when we started to see some massive sell side activity, we started to see the signal kind of turn itself back over, and that helped us identify a bottom. It wasn't exactly the bottom, right? Don't worry about that. But imagine if I didn't catch the bottom here, but then you knew about the signal, and then you caught it right here, okay? You caught it right here. Let's say, okay, cool. I'm just going to go along, get some exposure. I'll add in if it keeps going up. Well, yeah, you did pretty good, in my opinion, right? That's a huge move. And then we have also, we'll go over the sell side activity over here that led us to believe that this would actually happen. But this is getting back below that area, so we'll continue to watch it. This is what I meant by the sell side activity. Be very careful here. This is where crashes occur. We're looking at the summation index up here. That's the purple with the pink little dots. That's a parabolic SAR on the summation index. It's an overlay. And then the Nyesi-McClellan oscillator down here. NIMOT, this is a traditional calculation. And if you look at up here, this is just the New York Stock Exchange. We have some blue lines on our screens. That is showing when the summation index crosses down through zero at about the same time that we get a cross down to minus 300 on the Nyesi-McClellan oscillator. It has led to some bouts of extreme volatility and massive moves to the downside. It's given us big warnings. The reason why I'm showing you that is because you can see stuff like here, massive volatility and big moves to the downside. Right here, massive volatility, and then boom to the downside. Massive volatility right to the downside. And then also right here, leading right into 2022, gave us an identification right here, and we talked about it the day it happened. You can go back and watch that video, right? Because we also thought that it happened right here, but we got a 295 reading, and I was too stubborn to say that that wasn't minus 300, all right? But you can see it triggered again, and we saw a lot of volatility in the market started breaking down around what, 30% from its high? That's a big move to the downside. Why am I talking about it now? We got over a minus 400 reading, right? Minus 300 too, while the summation index is continuing to point straight down. This could be an early warning sign that we could get continued volatility and potentially even further move to the downside. This is a very, very weak market. If we zoom in right now, the summation index is pointing straight down. The parabolic SAR is still above it. All right, so to feel confident going long, I would like to see, once again, the summation index start to turn back up and the parabolic SAR to click underneath it to potentially identify a change in trend. Why, Michael? Why is that important? Well, look at the other times that the change in the trend occurred by the parabolic SAR. It happened right here where we saw the market start to move down. It changed over right here where we saw the market start to move up. It started here, right, and we saw the market move down. It is a very good identifier as trend. Now, another one, look at it right here. Boom. Now let's just draw a straight line from right here up. I'm going to be generous and just call it right here, right? It didn't mark the complete bottom, but was that a change in trend? I would say, yeah, that counted as a change in trend. Okay, so these are the type of things that I am paying attention to for the next leg, potentially up, or the possibility for a bottom, the bottom. I don't care and I don't know, but this is what I'm paying attention to. Here's another one, NASDAQ record high percent index. Okay, this looks to me very similar to 2008. You can see a lot of chop and a lot of chop. What you want to see is this to get below a minus 20 reading and then cross back above, up and through the 35. That has marked big bottoms, including long-term capital management, blow off over here to the 2000 top. It marked the bottom of the dot-com bust, the bottom of the great financial crisis, the bottom right here, the bottom of that hit, the bottom of the Christmas Eve massacre, and so forth, okay? So now we're back down into this region, and the reason why I'm saying it looks like 2008 is because look at how it got this extended reading to the downside, extended reading to the downside. We shot right back up, right, to almost just about 35, and then we came right back down to minus 20, came right back down to minus 20. This was all what? Look at this chart. Almost looks exactly the same. It's crazy to me. And it's going to look so obvious if this actually were to occur. But notice how the market, we bounced up right here in 2008, and then it came right back down to a matching bottom. Oh my gosh. We came here, we bounced up, everyone's saying, the bottom's in, and then we came right back down. Very similarly. So if I redraw that out, look at this. It looks like this. Boom, 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 boom. What? Boom, boom. What? Are we going to get a bounce? Boom? It's the same dang thing. It's crazy to me, but it's not even that. Take a look here. This is the Cohen high low, the Nasdaq Cohen high low. So when we get hits, and this is zoomed in to a 0.05 reading on the weekly time frame, it's marked bottoms. It marked the bottom of this minus 20% decline, marked the bottom of this minus 24% decline, which is the Christmas Eve massacre, hit the bottom of the pandemic too, which was a minus 33% decline. And look at all the chop that's taking place right here and how similar it is to 2008 and 2009. You can't make this stuff up. It is tracking not only from a price action perspective, but it's also tracking from an indicator perspective as well. Okay, so what happened here? Well, very similarly, right? We saw this, big old rip and rally, and we did that little, maneuver that we just previously drawn out, and we're doing the dang same thing right here as we're getting this 0.05 reading, which is actually marked lows, which is marked bottoms. So if we see some sort of a bounce and this starts to pick up, do we say, okay, that's the bottom? Well, according to 2008, no, we don't want to just say that's the bottom, but it could make for some great intraday trades. How do I want to feel even more confident? I want to see this line right here. This is the CPC, the put to call ratio. I want to see this cross down through 95, because when it does cross down through 95, when it does cross down through 95, and when it does, it has marked out some nice little pops to the upside. Now, this has not marked it perfectly on the T, right? It hasn't marked it perfectly to the T, but there's other indicators to help us identify that, if an earlier turn, such as maybe potentially the spring bottom fisher or so forth, but this might indicate that we have, 4, 5, 6 more days of an extended rally ahead of us. If we take a look at the CPCE, which is just the equity put to call ratio, this is actually starting to turn around right here. And the last times that we started to see it turn around, which is right here, which is right here, which is right here, it has led to short-term rallies as well in the market. So if this starts heading back down through 0.75, is that going to mark us up for a little potential rally there? It could. I went over so much data and I rattled on a lot. It is what it is, everybody. I also wanted to include the Qs and the IWM, the quarterly and monthly expected moves. I shared it with the Patreon, but I didn't want to extend this video out any further than I had to. So you can screenshot this, put them on your charts, do what you'd like. Be careful out there. Be safe. This is not an easy environment to navigate. This is as crazy as 2008 was, right? These are huge swings. You have massive volatility. You can make a fortune, but you can lose a fortune, okay? So we need to just focus on preserving capital, maybe slowly growing it, right? Preserve and protect your capital, because the opportunities that are coming, maybe it's hard to believe, but the opportunities that will come outside of this storm are going to be ridiculous. That's all I got for you. See you later.